All right. Good morning. Hope you all had a great weekend. Let me mute YouTube here. There you go. All right. Perfect. Oh, we got Alicia coming in. Hope you guys all had a great weekend. Pretty much the big news from last week is that consumer price index that we briefly went over last Monday. Those numbers came in higher than expected, and so we're going to talk about the consequences and repercussions and stuff like that, as well as kind of going over the cost of waiting for clients right now to be able to get the people that still need to buy into homes. Okay, so consumer price index came in at double the expectations for September at 0.4% instead of the 0.2% that they were expecting. Inflation is at 8.2% year over year. So even though we saw that monthly increase of 0.4, remember the way that CPI is calculated is rolled over from the previous year, right? They take into that account. They take into account that previous year's numbers. So we're actually inflation actually went down 0.1% from year over year. The news of the higher consumer price index actually came to us on Wednesday instead of Thursday. Not the actual number, but producer price index came out on Wednesday. And so the difference between the two is that consumer price index. Oh, is there somebody not muted? I got you. Consumer price index is basically inflation on the consumer level, while producer price index is inflation on wholesale level. So think of it like businesses is more producer price, consumer is more, consumers are more consumer price index, right? And so the producer price index also came in at 0.4% year month over month on Wednesday. So we kind of felt like CPI was going to do more or less the same thing, and it came in at that exact number as well. But to go back to the CPI report, what's the scariest number is core inflation, and that's what strips away energy and food costs. And that went up year over year from 6.3% to 6.6%. Okay, so even though the actual headline number that people like to look at went down 0.1% year over year, actual core inflation went up 0.3% year over year. And so even with us seeing that number of that, or that negative 0.1 number, the fact that it came in month over month higher, what's going to happen is now the Fed, if there was any news of any sort of Fed pivot in terms of what they're going to be doing, if they're going to slow down their rate hikes for the end of the year, that pretty much just went away. I think that now for sure these next 2 months are going to be increases in the Fed funds rate. And remember that they don't directly, that Fed funds rate number doesn't directly correlate with mortgage rates, but what they're doing with the economy, because we're in times where typically you would see, if we're in a recession, more job losses and things like that, which we're going to go over those numbers for initial jobless claims. But since we don't, we're kind of just pushing ourselves into uncharted territories that we've really never seen, with the Fed funds rate increasing that Fed funds rate because they're trying to fight inflation, but inflation is not really doing much to jobs within the economy, at least not yet. And so because of that, that volatility is going to continue to happen, and it's going to continue to hurt interest rates. From what they've said, specifically the Fed, is that they're probably going to stop by the end of the year raising their Fed funds rate. So going into next year, January, February, March, what's going to happen is the market is going to start reacting by itself, meaning that you're going to see bonds being bought here and there. They may not be a lot, but we're going to see steadiness. And that's kind of the first step that we want to see, right? Because like I've spoken to you guys about, what's happening with the markets, with the volatility, is that there's no liquidity within these bonds, within mortgage bonds or 10-year treasury. And because of that, clients are paying points, or they're paying extra fees and closing costs in order to make it work, so that when these loans get sold, Wall Street actually wants to buy them, right? And so as we get a little bit more steady and you see more liquidity within the bond market, even if rates are still high, we're still at that 5.5% coupon, let's say, or at that time we're at a 6% coupon. If there's some premium on there, remember 100 is basically zero. Anything above 100 is what they actually pay for these loans. And so right now, the coupon is at like 98%, 98.4, which means that they're not giving you 1-for-1 on your money on a 5%, a 5.5% interest rate. And so because of that, those points on the back end are being charged to the client. And so their closing costs are going up. Okay. Initial jobless claims was at 228,000 last week. That was up 9,000 from the previous week. And so 2 straight weeks of positive numbers could show that the job market is starting to soften. Remember, I told you guys that you don't want to kind of look at this number week over week. You want to look at it as a whole. That rolling average for the 4 weeks is starting to raise up again to what it was earlier this year. So we just got to continue to take it week by week, see what those numbers come in. And if we continue to see increases, then at that point, we're going to know that the job market is softening, right? If we start to get from 228 over time to 250, 300, so on and so forth, then we know that people are losing their jobs, and we're going to get that data week over week. So we'll be pretty much the first ones to kind of see that trend going up. And remember, job losses, even though it's not great for the economy, unfortunately, it's going to be good for real estate and for us, because what's going to happen is that will ultimately be one of the factors that could cause the Fed to pivot, and in that case, start buying back bonds if it becomes really, really bad, but ultimately bring stability within the bond market, which is what we're really looking for. Okay, so I'm going to be sharing my screen here. We're going to be talking about the cost of waiting, because right now, in my opinion, and you guys can chime in on this too, I think that there's two types of people that should be buying right now, in my opinion. First-time home buyers and investors. If you own a home, you're thinking about selling your home and moving to another one. I've had a couple clients reach out to me, and I've told them no, like, don't do it, right? If you're already comfortable in your home, stay, let the market play out. The reason why I believe it's good for first-time home buyers is because right now they're going to be getting a deal with sellers, and their cash to close is going to be much, much less. And that rate hit for them is going to be very minimal over the next 1 to 2 years, as opposed to paying rent and so on and so forth. The reason why I'm saying no to people that are looking to sell and rebuy that don't necessarily need to, they're not relocating, it's just because they're looking to, let's say, get a bigger place. The reason why is because they're sitting already at a 2.5%, 3% interest rate, right? Let's call it 3.5. So for them to go into another place, they're just going to be upping their costs. And with inflation the way that it is, minus what we're seeing in the real estate industry with food, energy costs and things like that, just doesn't make sense for them to do that unless they absolutely need to, right? And then, of course, with investors, because as long as that monthly rent number makes sense for you, with what you're getting that property and how much you're going to be able to rent it out for, it's still going to be a great deal. Especially if right now you're looking at worst case scenario, right? You're assuming that from here rates are going to come down, and you'll be able to refinance when they do, get a better interest rate as an investor, and now that profit is going to be much more in the future while you're still able to keep your equity. So those are the two people that I really think should be buying right now, and that I'm pushing home ownership or I guess financial freedom on. If you have clients that already have a home, the best thing is to tell them, stay in your primary, buy an investment. Okay. And so this is going to be specifically for first-time home buyers, is this cost of waiting. And so what we're looking at is a $400,000 purchase price in Broward, estimated the taxes, I think, at about $4,800 a year, $4,900 a year, something like that. These all pretty much have the same specs. Okay. The difference is the amount of points that client's going to pay, which we'll go over. And then what that interest rate looks depending on the program that they're in, and things like that. So I've got standard FHA, standard conventional, and then down payment assistance FHA, right? Because that's really probably right now the best option for first-time home buyers because of the cost for them in the back end. And so what we're looking at on the FHA, obviously 3.5% down of 400. So that loan amount is going to be a little bit different, right? Because this one we're assuming 5% down. That's the down payment amounts here. The interest rates that we're seeing. So let's say FHA is at 6.75, paying 1.5 points to 2 points. Conventional at 7%, paying 0.75% in points. And then down payment assistance as of today, the bond one, I'm not doing Hometown Heroes because that is very niche. I'm doing the bond, which is for any first-time home buyer. Their rate as of this morning was at 6%, and usually it's about a 1% origination fee that they charge. It's the same thing as the point, so I added that in there. So we have those numbers there. Then we have mortgage insurance. I put 185 on conventional, FHA standard. We know that it's the same across the board. Then you're going to see total monthly expenses, right, which is basically the amount of money that they're going to be paying monthly, which we'll go over now. Their annual expenses, which is basically this number times 12, and their closing costs. You'll see here on the down payment assistance one, I have it much, much lower at $2,000 because they're getting $10,000. So with FHA, I put 12,000. 12,000 minus 10 is at 2,000. Okay. And actually, this number is probably going to be a little bit lower on that down payment assistance one, but that's fine. So now you're looking and you're saying, okay, on an FHA, $400,000 purchase price, my payment is going to be, $3,383. My cash to close, let's say, is $38,545. I believe this is going to be real. This is really high. Possibly, let me edit this because I don't think it's going to be that much. Let me say 5,000 on that closing cost, because that upfront MI is being counted in there as well. So let's update that. Let's do conventional here, 5,000 as well. And then on the down payment assistance, I'm just going to put 0. Let's see what those numbers look like, because those look a little inflated to me. Okay, so let's say this may be a little bit more reasonable. I think the FHA is still a little bit high. It may be counting that PMI, the upfront mortgage insurance premium that you have to pay at closing. It may be counting it in here. So I would say minus that $6,000 there. So let's say 25, 28, 20. This is actually going to be closer to 20. But what you want to see is what those monthly expenses are going to be, right? Your payment, $3,383, $3,320, $3,194. Now, let's say on a regular FHA loan, we see how long it's going to take: 6 months, 1 year, 2 years, 3 years, right? And then 3 years, I think is going to be a little bit too long, as well as 2 years. So we'll just do 1 year and 6 months. We'll do this in 6 months. Let's say they go down to 6.75, only charging 1 point, right? So let's update that. That means that the cost is a little bit less for them. And then let's say year one, rates go down to, let's say by this time next year, 5.75, still charging that 1%, right? So we'll update that and we'll see what that looks like here. So now waiting 6 months, now look at the appreciation gain that it automatically puts in. This is forecasted appreciation directly through CoreLogic. Okay, so whatever that they think is gonna be the appreciation is pretty much what that number is. Notice that in a year, it's not gonna go up much, anywhere between 3 to 4%. That's what I've been pretty much preaching as well. I think we're gonna be in line with that. 6 months, 0.85. And so you'll see that difference in the cost of waiting for them in terms of what that payment's gonna look like for them. So 33.83, right? In 6 months, it's actually gonna be 34.06. It actually goes a little bit up, a little bit more higher, because not only the down payment, but the rate is going to be pretty much more or less the same, just paying a little bit less, my assumption. But even if it's a quarter less, it's not going to be too much difference in payment. And then waiting 1 year, right, you're getting that 3% appreciation. Your payment's going to be only $120 difference a month in a year. And this does not factor in them paying rent, which is important to add on top of this when you're talking to your client, right? And so that's the regular FHA one. We'll go based off of that one. So you're going to see here waiting 6 months, right? The total cost of waiting is going to cost them $5,400 in payment difference, in loss of property appreciation, and amortization loss, right? So paying down their mortgage in 6 months, basically. So you're $5,400. Let's say they have a 6-month lease. We know that clients typically don't. But let's throw that in there at $2,000 a month. That's another $12,000. So realistically, anywhere between $17,000, $18,000 is what they're going to be losing waiting 6 months. Okay. Now, waiting 1 year. Let's say, no, I'm going to renew my lease in December, and I'm going to be, hey, you muted? Okay, good. And I'm going to be renting for another year. Okay, fine. So next year, let's say rates are much lower, right? 1%, well, 1 whole percent lower. Your payment, you're going to save on that a little bit in terms of what your interest rate is. You're actually going to be saving $165 a month here, right? Let's factor that in, minus your loss of property appreciation, minus your amortization loss. your total is just on the property itself is about $18,000. Now let's add in 2,000 times 12 is 24,000. So 24,000 on top of that 17, you're losing about $41,000 waiting 1 year to buy your property, right? And so and these are conversations that we're having in our consultations now, but when you kind of show them this in person, they're like, okay, I get it, right? Because the difference in payment, right? Let's go to just today in 1 year is 33.83, 32.18. That's the difference in the rate, okay? 5.75, 6.75, not even including any sort of cash to close. And so when you're looking at the difference of what 1% is over a year, which is going to be a lot of a difference, I guarantee you, as soon as news says that rates are below 6%, you're going to see an influx of buyers trying to get pre-approved again. It just happens. It's the psyche. You're really only saving $165 a month. So you're saving $2,000. Basically, this is 1 month mortgage, 1 month rent payment is what you're saving over the year, right? And so when you have these conversations with them, you show them this is your amortization loss, your appreciation loss. It starts to click with them, okay? This is how much is going to be required after 1 year. So they're saving $1,300 in closing costs in 1 year. $1,321 is what they're saving by waiting next year. So if we add in that $1,321 in closing costs, that doesn't seem to be here. Let's say we minus that out of the 41, call it $40,000 that you're still losing. So you guys can see the difference there. The best option to me right now for clients is to really try to put them into that bond program, just because the bond program is limiting their closing costs. So you'll see here, this is 1.5. This is me assuming a 680, 700 credit score on an FHA. Okay. Realistically, if they're at 620, 640, their points right now are anywhere between 2 to 3. Okay. 2.5 points, 3 points. So think about it like this. Instead of 3.5% down FHA, add an extra 2% on that. It's 5.5% down on an FHA loan. That's going to make it easier for you to kind of understand what those points, what that point system means. And so buyers essentially going to have to come in with more down payment, except it doesn't go towards their equity. That's just money that's being lost because of that lower credit. So if they're at 640, 660, where they'll qualify for that down payment assistance, their cash to close. I literally did a consultation early this morning. That person was at 250. Their cash to close was at $12,000, right? Because they don't have to worry about those extra points that are paid, no matter what their credit score is. It's always going to be 1% origination fee for them because of the down payment assistance. It limits their costs, and that helps them on that cash to close. Which, even if they don't get approved for the DPA, regular FHA, we can still right now mess with sellers and ask for these things back, right? These concessions, and it's becoming a little bit more apparent right now for them as well. So I tell them, like, if you don't qualify for the down payment assistance, don't worry about it. Your realtor and I will make sure that we can get you cash back if we need to be able to help you minimize your cash to close. And usually that still can, that still helps them. The biggest thing is that payment shock difference for them. From what I've seen, it's not really the cash to close for the most part. It's really, wow, I'm paying $3,000 a month or $3,300 a month for a $400,000 property. That's crazy, right? But when you tell them if rates go down to 4 to 5.5, your payment difference over a year is not going to be that much. And so what you're saving, paying more over a year, as opposed to paying directly to your landlord, is going to be a much less when you're looking at just specifically what that payment looks like. So if you guys want this, I'll send it over to you. If you guys have any questions on it, let me know.
Good morning,
Yes.
Mike.
Yes, I will, Alicia. Hey, good morning.
Just wanted to tell you this was really great. It was very clear, easy to follow, and really makes a lot of sense. I think that this is going to give us a lot of good nuggets when talking to clients, and really being able to discern a client that's, ready to go right now versus someone who you should just say, pump the brakes. And that eliminates wasting a lot of time. And right now, time is money. So this
Yes,
is really, really good. Thank you, Mike.
no problem. Yeah, I was listening to a podcast the other day, and this is he's a loan officer, but it's the same sentiment. He was like, last year I could go check my mailbox, and my mailman would tell me that he's thinking about refinancing or buying a property, and if it was a good time, and that was that easy to get a lead. Now it's not like that anymore. Now it's about educating your clients and really making sure that you're more a service to them than they are to you. And actually, that makes sense. I just came up with that, but it's true, right? You have to be of service to them, not the other way around, because the clients that you're going to be getting, or the client pool, is going to be much, much smaller. And so how are you guys going to be able to stand out, and how are you going to be able to convert the leads that you get now, right? Because now it's not like, okay, they're going to be, rates are at 3%. They're going to be able to qualify for 350, 400,000, even though they only make $50,000 a year. No, right? They need to make some sort of decent money. They need to be a decent candidate. And most importantly, they need to be educated and motivated right now to be able to start looking for these things. And so you need to make sure that you have not only stuff like this, but other things for them, like, hey, don't worry about it. On my last deal that we just closed, I was able to get $10,000, $12,000 for the client. So if you're looking at your cash to close, you're most likely going to be able to get some money back, right? Let's look and let's see what we can do with the sellers. If we can't ultimately get money back, then we won't submit that contract, right? It's going to be the same thing as last year when you were submitting 40 and then getting accepted 1. You're going to submit 10 and get accepted 1 this year, most likely, because maybe some of them don't want to get that seller concession, but you're going to find, you and your client are going to find the seller that is going to give it to you because there's no bids on their property and they need to move, right? Don't forget the fact that the sellers are in a bad position right now too, because if they're selling, it's for a reason. And so it takes a little bit more catering to clients. And so the more information you can give them, I'm going to send this over to you guys. And the more stories that you can tell them about what's going on with the market now is going to ultimately help you continue to convert, and make sure that you're alive, because October, November, December, and maybe January is going to be very, very tough. Maybe October is already pretty much done with. So I would say November, December, January. Those are going to be the toughest months in this industry in quite some time. So those little leads that you get, make sure that you can convert them as much as possible. Ultimately, if they don't have the credit, if they don't have the income, there's not much that you can do. But from what I'm seeing, most of it is just motivation. That's pretty much it.
Thank you
Do you
so
guys
much,
have
Mike.
any questions
No,
or anything like that?
this is Arkayla. It's my first Mortgage Monday, and I learned so much. You just gave me a lot of motivation. I'm pretty new to the business in comparison to probably a lot of people on here, but you just gave me a lot that I can use, and I would love to work with you on the next deal. Maybe sit down with the client and do a consultation together rather than myself, because you're very knowledgeable, and thank you again.
Thank you, Kay. Welcome to the Monday Mortgage Minute. Yeah, we have some old timers in here that have been here from the beginning. So I'm glad to have somebody, a new face here, and hope to see you every week.
Yes, sir.
You guys good? You guys ready for this week? To tack on these difficult clients that we're having lately?
Yes, indeed. I need to go make a video.
I'm gonna make a video. I'm gonna make a video today too, kind of breaking this down for other realtors as well. Because once you start, because we implemented this in our consultations, and we're getting some eye openers from clients when you're really telling them how much money they actually lose, and you break it down to them. Waiting that specific amount of time, it's helped us with our conversion with people that are pre-approved. So yeah, definitely make your videos, reach out to your clients. It will help your conversion just a little bit more, to be able to get that client that may have been on the fence because of what's going on to possibly start looking with you, and that's going to be a deal in your pocket.
Per usual. Thank you, Mike, so much.
No problem. Thank you all. Have a good Monday. Have a good week. Anything you guys need, don't hesitate to reach out to us, okay?
Thanks.
And I'll send this over to you guys. Don't worry. Oh, hold on. Don't leave. I need to make sure who's here. How do I open this thing up? Participants. I think only Kia left. Okay. All right. You guys are good. See y'all next week.
Bye.
Bye.
Bye, Mike. Thank you.
No problem.